A lot of people try to maintain a 0% credit utilization rate to help their credit score, but is it really necessary for obtaining an excellent score, or does it hurt your score? What's up, and welcome to Smart Money, where our mission is to give our viewers the motivation to make more money and the skills to keep it. Today, we're going to talk about the credit utilization rate and its relationship with the credit score. Please give this video a thumbs up before I go on so that the YouTube algorithm can continue to deliver you videos like this. Also, subscribe and turn on the post notification. So let's get started and uncover some facts. What is credit card utilization? Before we talk about how using a credit card can affect your credit score, let's talk about credit utilization. Credit card utilization refers to the amount you use in a given time from your available credit. It is also called the debt-to-credit ratio. Credit utilization can be easily calculated by dividing your total credit card balances or current debt by your total credit limit. You should remember that credit utilization is not calculated on just one credit card. Instead, it is calculated on your total available credit on all the cards you have. Let's say you have a credit limit of about $100,000 and have utilized $10,000 of it. Your credit utilization can be calculated by dividing $10,000 by $100,000 and multiplying it by 100. In this case, the credit card utilization will be 10%. As I mentioned before, you have to use the total available credit. So if your total available credit from all your credit cards is $400,000 instead of $100,000, then your credit utilization will be 2.5% if you have used $10,000. Keeping the credit utilization rate below 30% is preferred because this conveys to the creditors that you can use your credit responsibly instead of relying too much on it. A low utilization rate always leads to higher credit scores. What is a credit score? Now, before I go on and establish a relationship between credit utilization and credit score, let me briefly tell you what credit score is. A credit score is a three-digit number somewhere between 300 and 850 that predicts how likely you are to pay your debt on time. A high credit score means that the person who has borrowed the money is at lower risk and is likely to make payments on time. A low credit score means the opposite. The credit score is affected by many factors, like payment history, credit usage, types of accounts, etc. Many important decisions of the issuers, like whether to offer someone a mortgage, auto loan, or credit card, etc., are affected by the credit score. Why does credit utilization affect lenders? Credit utilization is an important factor in the eyes of the lender. If a person goes over the credit limit daily or constantly charges all the money they can, the lenders get the impression that such people would have difficulty paying the amount back, and they can delay the monthly payments. Lenders prefer those who charge small amounts because they are a lower risk for the lenders and can pay their debt in full each month. How does credit utilization affect your credit score? Credit utilization affects credit scores, but there are many credit card scoring models, so it is difficult to generalize the effect. But one thing can be said that the credit utilization rate and credit score of a consumer are strongly related to each other. People who like to keep their credit utilization low usually have high credit scores compared to those who max out their credit cards frequently. If you spend too much regularly, then the chances are your credit card utilization will negatively affect your credit score. That's why it is important to focus on your spending habits. Your credit score also depends on your spending habits, your credit history, and how many credit cards you have. The chances of hurting your credit score are high if you have high utilization on a single card and you have a short credit history with just one card. But these effects can be reduced if your utilization is spread across multiple cards and you have an excellent credit history. A low credit utilization score means you are spending less than what is available to you, and you are doing a pretty decent job of handling your credit. Low utilization and a high credit score increase your chances of getting extra credit when needed, like for a car loan, home loan, or credit cards that offer better terms. A credit score is affected by credit utilization. No one can deny this, but you have to keep the broader picture in mind because there are other factors that affect your score. Is 0% credit utilization good? Many people think maintaining a 0% credit utilization ratio means they are going to get high credit scores, but it shows the lenders and credit card issuers that you are not using your credit card in making any purchases. Remember, you should always use your credit card. If not, it means that your card is not in use for many scoring models. The best approach is to use your card in a very controlled way to maintain low utilization instead of completely shutting down your purchases. Also, many people confuse clearing all the balances at the end of the month with maintaining a 0% utilization ratio, but this is not the same. The credit scoring systems calculate the credit utilization based on the balance information the card issuers report monthly to national credit bureaus like Equifax, TransUnion, and Experian. The balance reports are made by the issuers according to their own schedules. They are then sent to different bureaus at different times. Then the bureaus have their own system for revising your credit score after getting updates from the card issuer. When you use your credit cards, your utilization will vary from one credit bureau to another, although all of their records will be accurate. Let me give you a simple example to explain this. Suppose you use a credit card with a $5,000 credit limit and zero balance, and you make a purchase for $500 on the 10th of the month. You then pay the balance on the 20th of the same month, even before it has a chance to appear on the statement. Now, if your credit card issuer updates your information to Experian on the 15th, then your credit scores will reflect 10% utilization based on the data of Experian by the end of that month. But another credit bureau that gets the update on 25 will show a 0% utilization on the card. When multiple cards and balances are involved, then your credit card utilization and credit card scores are moving targets. The only way to make sure you have a 0% utilization is to refrain from using your credit cards. But as I said earlier, this is not a preferred strategy because of the potential risks. The pitfalls of not using your credit card. The people who adopt the strategy of not using their credit cards to get a 0% utilization should know the pitfalls of doing this. Firstly, there are chances that your credit card issuer will close your account if he sees an extended period of inactivity. If this happens, it can decrease your available credit, which can cause your overall utilization to rise and your credit score to drop. When timely payments are made over time, then it has a positive impact on your credit score. But when a card issuer closes your account, there is no appearance of any additional payments you may have made on your credit report. Eventually, if your account is closed and there has been no activity on your credit report for over 6 months, then no credit score is generated by FICO. You may avoid this if you have other debt payments, but if you have credit card accounts as your only form of credit, then it can mark you as credit invisible, making it difficult for you to acquire new loans. You definitely don't want this to happen. So make sure you use your credit cards a few times a year. What you can do is make small purchases with your card so you can quickly pay off the balances without getting any interest rate, so your issuer knows your card is active. What is the ideal credit card utilization rate? It is not necessary to keep credit utilization close to zero. Experts advise keeping the utilization rates below 30% to avoid any drop in the credit scores. 30% is a general guideline, and it is not something to follow strictly. The ideal utilization of your card depends on your credit history and how long you have been using credit cards. Many people with FICO scores keep their utilization ratios under 10%, which is considered healthy for your credit scores. How to lower your credit card utilization. I know many of you will be wondering at this point how to lower your credit utilization to achieve high credit scores. You can lower your credit utilization if you make your credit card payments more than once a month. This will help you keep the utilization under 30% and your balance will never get high. Also, the credit card issuers send your credit report to the bureau once a month, so if you pay all your balance or the major chunk of them before your credit card activity is reported to the bureau, you can lower your credit card utilization. Increasing the amount of available credit is also an approach you can take if you have been using a credit card account for more than a year and have made all the payments on time. If your credit limit is raised, it will immediately decrease your utilization of the outstanding balance. Many people go to open a new account for the sole purpose of reducing the utilization rate, but let me tell you, it is not advisable to take on more credit than you need. New credit applications can knock down your credit scores a bit. Before you can take advantage of any advantages from lowered credit utilization, you must temporarily deal with the increased utilization. Most of the time, people go over their credit limit because they are unaware of how much they have reached. So the best way is to set an automatic balance alert so you can be notified when you are close to reaching your limit and avoid increasing your credit utilization. Spreading your charges across multiple accounts is a good idea to reduce your credit utilization. Instead of keeping one account with high utilization, try to keep multiple accounts with low utilization. Some of the credit card scoring models look at the overall utilization, so this technique may not work in some cases. From our discussion today, we can conclude that credit card utilization plays an important role in attaining a healthy credit card score. You should definitely focus on maintaining a low utilization ratio, but not using your cards at all is of no use and can cause problems for you in the long term. Try to practice a good debt management strategy so you don't overuse your credit or miss payments because that will adversely affect your credit score. Pay all your balances to avoid payment defaults and interest. Keep your utilization within a healthy limit, and you can enjoy the perks of a good credit score. Check out these videos on your screen on how to improve your finances. If you like this video, hit the like button to receive more content like this. Be sure to subscribe and share the video with your friends. Thanks for watching, and I'll see you in the next video.